Welcome to Mutual Fund Cafe. Indians have started investing in equities and in mutual funds yet again after a 3 or 4 year hiatus, so much so that even when foreign investors pulled out over $1 billion in the past few weeks, domestic funds have stepped in rather easily to support the market. But this is not just a market level issue. It is important for the country that mutual funds are once again emerging as a favored asset class, as a favored investment instrument. Today I have with me four of the foremost fund managers who collectively manage between them about $25 billion or 1.5 lakh crores of funds. I have with me Prashant, Jain, the CIO of HDFC Mutual Fund, Naren, the CIO of ICICI Prudential Mutual Fund, Mahesh, Patil, the Co-CIO at Birla Mutual Fund, and Harsha, Upadhyaya, the CIO at Kotak Mutual Fund. The best and the brightest in the industry are with me. So expect a fund of wisdom and information from them. Gentlemen, thank you very much for joining me. Well, let me start with you, Prashant. Like we have introduced this topic, about 50-60,000 crores have flowed into the industry over the past 1 year or so, after a degrowth, after an outflow for the past several years. Now, I will revisit the topic of importance of mutual funds. But first up, what confidence can investors have that they will not see too much losses? Do you think that this market is likely to give serious losses in the immediate term? Or do you think, maybe some losses? What kind of losses should investors be prepared for?
So I think equities are a volatile asset class in the short run, and it does not make sense to focus too much on the short run. And in fact, short-term focus takes people away from long-term substantial profits. And I think PE multiples are a fairly reliable indicator of how markets tend to behave in the future over 1 to 3 year periods. If you look at the current PE multiples, despite markets trading at 28,000, PEs are not expensive. And that is because over the last 7 years, from pre-Lehman, from Jan 08, markets are up only 30%.
Okay.
But the nominal GDP in rupee terms is up more than 100%. So markets have basically played a catch-up in the last 1.5 years. I would say they are quite reasonably valued. Interest rates are sitting at near peak. They should move lower. Economic growth, I believe, should improve. I think equities are a good, promising asset class with a 1 to 3 year view, but I would not urge people to invest in equities with a very short term.
No, I take your point on that. In fact, if in that downturn people had continued to work with their SIPs, there would have been less regrets now and perhaps more money that they would be. I take that point. But nevertheless, for that 60,000 crore owners who came into the system in the past 1 year, there is still a bit of trepidation on whether they would be sitting in near-term losses. Just for the purpose of my headline, if you please, do you think the Nifty can go much lower from current levels, or do you think it's kind of reflecting economic fundamentals now?
So I would first say short-term is genuinely uncertain in equities, yes. And most of us, whenever we have tried to guess the markets, more often we have been wrong. Having said that, I feel the way economy is moving, the way things are looking out, and I think over 6 months, 1 year period, to my mind, the downside is quite limited, in my opinion.
Okay, you would concur with him, Naren?
Clearly, one is looking at India. From an India point of view, you have much lower fiscal deficit, much lower current account deficit, much lower inflation,
yes.
Now lower interest rates. So I think from an India perspective, so what we have seen from our past experiences, if there is a big bubble in some other part of the world and that bubble deflates, then it can have an impact. The way the Chinese market has been going up, if the Chinese market goes up another 50%, then what happens is, Chinese valuations will become very high. And as it is, I can show you, I get mails showing a lot of stocks trading at 100, 200 PE in China. So I would say the risk of a serious correction may not be from an internal reason. It could be from a reason that China goes up another 50% and then corrects 50%. Then we will always have some collateral impact. I think that's why we believe that investors have to invest for the long term and choose to invest defensively. I think if they do and they follow asset allocation, I think then market volatility is a benefit to them.
Okay.
It is not a problem.
No, I take your point that we should be looking at the longer term, but nevertheless the trepidation is still there. We've lost 11% from recent highs, and therefore there is just a niggling worry whether in the near term things can get a little out of hand. Is that something that you suspect? I mean, are we looking at 7,000? Are we looking at 7,500? Is it a manageable kind of fall that we will see?
See, I think first, if you look at it now, investors are very fond of pure small cap funds, small and mid cap funds, and funds which have very big investment in small and mid caps. So today, if you look at the large caps, they are reasonably valued. And even the quality large caps, which we used to be very negative on, and some of them in the pharma and consumer space, some of them have corrected pretty significantly. So I would say that if investors are genuinely worried about downside, they should choose either balanced kind of funds or choose large cap funds, and not choose funds which can go substantially into mid and small cap, because in mid and small cap, some of the stocks are trading at 40-50 PE. So they can correct, whereas if you don't look, it doesn't look at this point of time that large cap is expensive.
Fair point. Prashant spoke about reasonable valuations once again emerging. Let me take that point forward, Mahesh. What is your sense in terms of actually when the earnings cycle turns? We've been waiting, every year, or at least for the last couple of years, we begin with a double-digit earnings growth expectation, and then with each passing quarter, it whittles down to sometimes low single digits, as we saw in the fourth quarter. What kind of an earnings growth should we be prepared for in FY16?
Yeah, I mean, you're true that, very true that in the last few years, we have seen that actual earnings have been lower than expectations. In fact, if you look at the CAGR in earnings in the last 5 years, it's probably around 8% or so, which is below the long-term trend average. So if you look at long-term 10-year average or a 15-year average, would be around 13% earnings CAGR, which is broadly been in line with the nominal GDP, or slightly better than that. And the reason why we have seen downgrade in recent past is because the revival in the economy, which we have been expecting, has been elusive. And if that comes in, and we believe that this year you would see economy expanding, if not by at least 50 basis points or so. And the reason for that are multifold. Okay, one is that government expenditure, which has been contracting in the last few years because of the fiscal deficit. I think this time there is enough room for the government to spend, and we've seen the first month numbers, April numbers have shown an increase. So if that trend continues, I think that could give a flip to the economy. So obviously if GDP grows higher, you will see corporate top line moving faster. And to some extent operating leverage, we have seen that coming into play. A lot of companies in the downturn have been able to actually tighten the operations, both on the working capital side and the cost side. That benefits start to come in as you see growth starts to pick up. And we believe that this year growth of around 15 to 20% is quite possible.
18 to 20.
15 to 20%, in that range. Because last year, I think there were a couple of one-offs which were there. That's the reason why the earnings were such a disaster than compared to the expectations. Like, be it cross-currency impact, be it commodity prices which fell sharply, which led to some inventory losses. We saw some extra stress on the banking sector, especially the PSU banks. Those might not reoccur this year. So I think it's reasonable to expect that with some pickup in the economy, and with kind of earnings, EBITDA margins where they are, and also the commodity prices which have fallen, the full benefit has not really flowed in. It might come in this quarter. I think it's reasonable to expect 15% or above growth in this fiscal year.
You agree, Harsha?
I would say that probably the earnings growth momentum will pick up maybe towards the end of this financial year rather than immediately. I think even this particular quarter we are not seeing a great change in fundamentals for many of the corporates. But I guess as Mahesh mentioned, the commodity prices which actually took away some of the profits of Indian corporates will start acting as a positive trigger. They will start aiding margins going forward. And we have also started seeing some amount of pickup in terms of government spend. And then when there is some amount of volume growth, I think the operating leverage will kick in and you will start seeing better numbers. But our guess is probably it's going to be a little back-ended than immediately. It's not going to be evenly evenly moving up in terms of earnings growth. But I guess second half and probably FY17, wherein you will also have the benefit of some amount of deleveraging and some amount of lower interest burden, will be the years and quarters to look for.
Okay, Prashant, to come back to you, which is the turning quarter? We've been expecting the turning quarter or the turning half of the year or the turnaround year. Should we expect that turnaround by the latter half of this year at least?
See, if you go back to 2003, we were in a pretty similar situation. The capex cycle was virtually dead. Interest rates were quite high.
Absolutely.
And corporate profitability then, the aggregate EBITDA margins of the Sensex companies were close to all-time lows. And last year we were in a similar situation. Interest rates at near peaks, and EBITDA margins last year were at a 17-year low.
Okay.
And I think the markets are in transition. Where have the big disappointments come? They have come from sectors which were doing extremely well. The consumer staples, the pharmaceuticals, the IT services.
That's right.
So I believe these are markets in transition. The economy is improving. I think economic improvement we will see in the current year, in my opinion. Few lead indicators are already telling us that. So yesterday I met a company and they said that now trucks are not available off the shelf. There is a waiting period of 2-3 months. So I think we are seeing very good traction in roads, in railways, in power T&D. It is building up, and I think current year we should see. I think next few years the earnings growth should be very strong. 2003 to 2008 earnings CAGR was 25 to 30%. So I'm not saying whether we will be 25 or 30, very hard to say, but I think earnings, like Mahesh said, last 5 years have been below trend. I think next 4 or 5 years should be above trend decisively. Whether that trend improves above, the number improves above trend this quarter or next, I don't think is material or anyone is able to forecast. But I think if we take a 2-3 year view, I would be very optimistic on earnings growth rates.
Yeah, but this 15% growth in FY16 looks possible?
I think, see, individually companies have already been doing well. If you look at banking, for example, even last year was a reasonably good year, at least for all companies in Sensex or Nifty. And so I would say that it should be possible. See, the trouble with the aggregates is a third of the Sensex is globalized. So you have a commodity company there. Someone takes a big write-off. Now, how do you build this into? But if you talk of sectors, I think the automobiles, the capex related sectors, the banking, their earnings should do quite well. And I would say the consumption related sector, in my opinion, should continue to lag estimates.
All right, gentlemen, hold on to that thought. We have a lot more questions for our mutual fund experts. We are back after a very short break. Stay right there.